Good morning. My name is Seth, your Metro Detroit real estate expert, and today with me I have Steve Frost, as always, with National Mortgage Funding. How are you?
Doing fantastic. How are you?
I am terrific. Coming in with some good news today. Spring has sprung. Rates are under 7%. I think 7%, if I'm not mistaken, has kind of become that new number that once it gets over, it's a bit more painful. Even when we're at 6.99, it feels a lot better than 7.01. Is that right, Steve?
Yeah, there's for sure a stigma,
Yeah,
So
absolutely.
we sell a lot of 6.99, but I mean, right now, we're coming back to so yeah, we're writing a lot of loans at 6.99% with some cost. So you're
hmm
paying a little bit of extra points to buy that rate there.
hmm
And the difference is without paying the points, maybe you're going up to like 7.375. And we go over like, hey, this is what your cash to closing looks like at this rate, and this is how much money you save. And you really, even though a lot of times like it doesn't make 100% sense to buy that rate down and pay that extra cost up front, especially knowing what's going to happen with rates, there's just a psychological hurdle that people can't get over. And so it is what it is. That 7% really scares them off. So you do the 6.99 and everything it's still a good rate. And I mean, we're not going to put anybody in a position that doesn't make sense. As long as we can meet your cash to closing goals and your monthly payment goals, then it makes sense to buy a house. But just sometimes people don't always want to hear my analytics.
Yep, absolutely. And because of that, where we're at, mortgage purchase applications are up 11%, I think, just from last week, right, Steve?
Yeah. Yep. So this year, so I've seen that it was said that transactions are down like 22% year over year for the month of February.
Uh-huh.
And while it seems like a lot, that would be a rough start. Last year, we also had a run in the high fives to start the year, which really ramped up purchase closings kind of really abnormally for January. Like even on a regular year, we did a really big January. So being down 20%, it's still a pretty active market right now. The good homes are getting snapped up fast. And the ones that aren't, that's what this market does. That's what rates do is it makes the buyer discriminate a little bit more. And so I have I'm closing a loan, or I closed a loan last week. The listing price was 499 and they closed at 555 for purchase price. So some of the right houses are still taking those, offers over asking and all that.
Yeah, that's crazy. And we've said this time after time after time after time, and we'll keep saying it. When you have a house that's move-in ready with the rates that they are, and it's up to code and everything looks great, and you can pretty much move in without doing any renovations. A generation like mine, most people want to move into something without work, so they're willing to overpay for that house as long as it's priced right, to get into it as fast as possible. Right, Steve?
It's true, man. Gray walls and white kitchen. Get
Exactly.
some get some sold fast for sure. So,
Exactly.
the big driver though, like we always talk about like what's driving the rates. This is a huge economic week. So, 2 weeks ago we had a lot of the inflation data, which was not great for rates. We saw inflation numbers run a little bit hotter than we thought. So now we're really going to rely on the labor market. So why do we rely on the labor market for data on what drives interest rates? So if inflation is going up, right, and you have a labor market where there's a lot of jobs, because why do people leave jobs? Typically, and based on surveys that the government does, is to make more money at a different job. So
Right.
you have a high quit ratio. And the reason you have a high quit ratio is because there's a lot of job openings. So you think you can move to a different job and make more money. Why do you want to make more money? Because the price of goods is going up. So rather than changing your habits, I'm going to go get a new job where I can make more money and I don't have to change my habits. I can just absorb the price increases by making more money.
Right.
And so this week we saw what we call the JOLTS report, which is jobs over labor turnover, basically. So that measures how many job openings there are, which was like 8.5 million job openings. And so that's like a pre-pandemic level. We're getting back to like very normal amount of openings, but the quits ratio went way down, which is saying that more and more Americans right now are feeling less optimistic about leaving their job to go to a new job. So they really liked seeing that. We saw yesterday private payrolls, which is different than kind of the manipulated government numbers, came in below expectations at like 140,000 jobs. Today, we got some information out of Europe saying that the European inflation expectations are going to be lower than they thought. So we really like that. We also saw that the continuing jobless claims. So that's where people stayed continuing to collect unemployment, went up to 1.9 million claims. So that's basically people that are still unemployed after 5 weeks. And so as that number grows, it's again showing a softening of the labor market. So rates really like that. So why does all that matter? So it all factors into when is the Fed going to make their first rate cut? So before, everybody thought it was going to be in March. We knew that wasn't going to be the case. So now what they're really looking at is the June Fed meeting. And now we're starting to see some labor market softening. Hopefully, what happened, the government changed the way we look at the way they measure inflation for housing, which ramped up so their growth rate of inflation was still continuing to fall. The government just changed how they measured something. So it just made it look higher. So the markets have kind of settled into that. So now we're starting to see those 6.75, 6.99% without paying any extra cost is what that's led the market for. Tomorrow's our big day, though. That's the government jobs report. Even though we all know that number is crazy manipulated, it just is. It's just a mental panic, big number, big market mover for the market. So we'll see what happens with that tomorrow. But really, we're looking at a lot of jobs. Can people leave their jobs to get another one, to make more money, to be able to spend more money rather than changing their spending habits, which is what the Fed wants us to do, is stop spending money.
Got it.
If anybody's still awake, that's why.
Perfect. And I don't have too much more to update as far as the housing market goes. One thing I do have to add is that touring activity over the past weeks up 23%. We're seeing a weather break nationwide, especially here in the Midwest. So a lot of more people are starting to pound the pavement and looking at houses, right? Here in Detroit, the data hasn't came out yet for this month, so we'll have to touch base next week or the next. It usually comes out a little bit delayed for February, but nationwide, listings are continuing to rise. They're up 13% right now. Detroit Metro usually lags behind that a little bit because obviously we're one of the colder states here in the Midwest. So we might see that number lag for us a little bit, but as I've been looking at the market, it does seem to be coinciding with that. We are seeing some more listings going up, and we are seeing more buyer activity as far as the market goes. And it'll be nice to see if we can get back to more of a balanced market, to where there's inventory out there and there's buyers out there, and they're kind of in the same range as far as supply and demand goes. It makes for an easier market for buyers for sure, and then it just makes it nice, and it makes it almost more smooth for sellers. Even though you won't see those crazy numbers, it's actually less stressful just because there's more of a balance. It's hard to describe, but it's just true. So please take my word for that. Right, Steve?
Yeah, there's something to be said for balance.
Exactly. So other than that, I don't have anything to add on. What about you, Steve?
Nope, that's it. I will say something for the housing market. So kind of the gold standard for measuring, as an index for measuring property values, is the Case-Shiller Home Price Index. And if you look at the Case-Shiller Home Price Index, they look at the whole country. I actually, based on the information that we see, Metro Detroit is, when it comes to what we call FHFA, so non-jumbo loans. If you're not looking at jumbo loans, Metro Detroit, we would have seen from January of 2019 to January of 2024, a 46% increase in property value. So if you bought a house in January of 2019 for $225,000, that house today is worth like $330,000. And just that 5-year period, which, like, oh, I don't know. I mean, is that big? I mean, it's huge. I mean, if you look at like normal 4% increases, you'd be looking at maybe $30,000-$40,000 annualized over that time. But you look back at it now, it's like, I mean, that's just a really, really big number. So yeah, is the housing market kind of crazy as a buyer and a seller right now? Yeah, absolutely. But shout out homeowners. I mean, if you own a home, and that's the thing, especially if you start thinking about some of the people, like, what's up with some of these housing prices, for normal homes. Well, if you had think about a $400,000 home is now worth almost $600,000,
right?
Based on that same premise, which is just bananas. So
Yeah.
something interesting to think about.
Yeah, absolutely. Thanks, Steve.